Okay, good morning, traders, and welcome to this live intraday strategy webinar on SB Trade Desk. Today is Tuesday, July 23rd. Mike Boutros on the horn with you. Pooja, Peter, and Pete in the house today. Kamal, great to see you guys in the room. So, interesting price action. The dollar, as we had alluded to yesterday in the webinar, some strength is expected here early in the week. We're getting that. I'm looking for that to fizzle by near-term resistance. So that puts a little bit more downside pressure on Kiwi, Aussie. We'll talk about dollar CAD, which is approaching resistance too on that rebound. The dollar Swiss setup still basically holding weekly opening range. We're going to look at that again today. And the SPX with that rally also looking for resistance nearby. So Pete, we'll go over those levels as well. Also on the list, Euro, Aussie, gold, crude, and a quick look at Euro Kiwi. It's a setup that we've been following. Came into support. You can see it here on the chart. Came into support last night, or yesterday rather, I should say, and we saw a little break of a near-term uptrend or downtrend resistance rather. So might have a little bit more upside to go there. We'll take a look at those levels as well. Any other questions or trade setups? As always, feel free to throw them on the message board at any time. Quick look at the DXY to start off the session. Here's what we're looking at. So a quick reminder, weekly chart, nothing's changed. DXY still holding in this critical range to 96.14, yearly open support. Fibonacci resistance at 97.87. That's still the range we're trading in. Okay, so on the whole, momentum trigger rather is still in play. Key resistance still in play. Looking for some sort of reaction on a move slightly higher from here in the DXY. Here's the daily. Today's close is critical. So the opening range highs for the month on that initial stretch when we just ripped right into the open of July trade was 97.57, 97.59. I'm sorry, 97.59. We're basically there now. Okay, so today's close will be paramount. Hey Jay, yeah, good morning to you as well. Mark, great to see you in the room. It's going to be about today's close will be paramount. So if we close above this region, that's an objective break of the monthly opening range high and would certainly have us looking for a late month high. I mean, it's the 23rd of July. If we're going to get that opening range break, you'd expect to see that late month high basically into the close of this week. So watch the close today. It's a very precarious position as far as I'm concerned with the DXY. Momentum, if we close at these levels, again, you're marking divergence with inability to mark a new high in price. So the hallmarks are there, but the near-term trade setup, not quite. Here's what it looks like on the intraday chart. This is the 120. Just going to zoom out real quick to show you the longer term. There's that pitchfork that we've been following. A little messy on the median line, but we got the bounce. There's another one. Here's the opening range highs for the month. So really, the onus is on the bulls to push this through. If we fail here, or even if this spikes intraday and closes below, that would be, in my opinion, a tradable asset to try to fade that strength. As it stands right now, watch below. Okay, it's testing the 70 threshold in momentum. If we're able to push through this accelerated move, should see 97.87 pretty quick. So DXY still unfortunately holding this range from last week, testing the upper bounds. If we're going to get exhaustion, this would be the spot. As far as economic data and event risk is concerned, guys, you do have U.S. second quarter advanced read GDP out on Friday. And not only that, but we also get those updated core PCI numbers or PCE numbers, the price consumption expenditure, which is the Fed's preferred gauge on inflation. All the while recognizing that the FOMC is on tap next week. And obviously that interest rate cut is already essentially still priced in. So watch the DXY here. Pretty precarious as we test this upper bound range on the index. Any questions on this? There's not much to do here besides look for reaction early into the US trade session today. If you're holding longs, a good spot to bring up any stops. Take a little off the table. If you get that breach, 97.87 is still the long-term fib that we've been talking about for a while. And that's certainly reflective here on the weekly chart as former swing highs. The high week reversal close, by the way, a level that I just like to eye out. I didn't want to put it on the chart to keep it a little clean, but it's right here at 97.61. Again, essentially the high that we just made today was exactly 97.61. So the high day reversal close, typically a level of significance from a technical standpoint. You got the 97.87 barrier just higher. Look for possible exhaustion up here. Any questions on DXY? That is number one. Now let's jump into last night's update. First of all, Kiwi dollar. So here's what Kiwi looks like. So just to start off, again, we'll come back and check out Bitcoin actually today too. Let me put that on the list. The Kiwi weekly looks like this. So I showed you guys this yesterday. The weekly close last week right below that 618 retracement of basically the entire yearly range. The drop here from March puts, well, we started the week. Ty wants to take a look at the DXY combo. Yeah, sure. Here you go, Ty. Daily chart and 120. Feel free to take a snapshot there. But back to the weekly on Kiwi, the basic premise here again is going to be what we get to start off the week off this 67.64 level. Yearly open support objective comes in at 67.05. And if you guys recall from the update, that was the level that we were looking for as our near-term bullish inbound. So even if we were to get a drop here to 67.19, which is basically what we're testing earlier today, 67.05, both areas of interest for possible exhaustion. We're looking to see basically if this breaks lower. Obviously, the premise of this being some sort of bull flag didn't really work out with this downside break. So again, these levels both of interest. If we get a drop, if Kiwi's heading higher and this breakout is legit, that's what you'd want to see hold support. Okay, here's what the intraday chart, or let me start the day first, looks like now. Okay, first thing I want to highlight that we already just tagged is, again, that monthly open support, right? An objective range, obviously looking at this laterally, just objectively in price. You can see former swing lows from February, former swing lows from April before we broke, failure to break up into that and close the month there last month. Here we are again. It's a range of 67.05 into 67.12 is the 50%. Monthly open is right here. Real clean. Okay, real clean. So let's see what kind of reaction we get down here in Kiwi today. Here's the intraday chart. Yeah, Ty, I'll go back to it in a minute. Gotcha. Here's the intraday chart. And again, whoops. Here's the 120 in comparison to what we look like yesterday. The levels have been really clean. So on the short side, there's the break, 67.37. That's now near-term resistance. We did get a tag of 67.19. You had a reversal candle, outside reversal candle off that mark, and we're just testing near-term resistance. Look, at the end of the day, weekly open comes in right here, just below that 618 extension. So you're talking about like 67.62, 67.66 areas of interest. If we get through that, look for the resumptive move towards 68. In the meantime, right now, I don't have any positioning on this yet, but if we get into the US Open and we get a decent opening range break to the upside, it needs to be either a break above this for resumption back towards that 67.66 threshold, or the better play for me is if we do get that last dump towards 67.05. It completes a basic 38.2, so just on its face of the monthly range from the July low, gives you a 38.2 retracement of that ascent, and obviously objective yearly open comes in at 67.05 as well. So a nice zone for this thing to get into before we start to see, or before start to look for a little bit more of an exhaustive trade. What else can I say about Kiwi here? Any questions on this? The dollar rally certainly testing the limitations here. Ty, here's DXY one more time for the combo. Here's a 240 on that. All right, just let me know when you got that, Ty. But any questions on Kiwi, speaking from here, guys? Looking for reactions, either the resumption with a crack and push back above the opening range for US above 67.37, or like I said, the better scenario would be if we were to get the final spill towards 67, look for a larger reaction there. That is Kiwi dollar number 2. Ty says Euro. I have Euro on the list, but you know what? Let's go out of order a little bit because I do think Euro warrants close attention as we head into the U.S. trade session. So does Sterling, guys. I know that obviously, if you haven't heard, Boris Johnson is going to be taking the mantle here as Prime Minister of UK. Big advocate, obviously, for the Brexit movement, and the UK from a geopolitical risk. Not to get too much into the weeds here, but they're facing two things that he's going to have to address right on there's going to be no honeymoon, essentially. He's going to have to get in right into, take that mantle and just run with it because they obviously have, he's committed to the October exit in Brexit. So whether it's going to be disorderly Brexit, no deal, as they call it, or, bilateral deals, we'll have to get that in play. That's basically what the markets will be looking for from Boris. And also this new tanker Iranian debacle. And how they're going to look to, navigate that. Those are the two main geopolitical risks. But we'll come back to sterling in a second. Here's euro. So for euro, very similar to DXY on the intraday, but not on the weekly. Okay, we're testing that massive important slope back from the 2015, 2017 lows. We talked about this, guys, in the webinar on Thursday, on Monday, yesterday on Daily FX. On a close basis from a weekly standpoint, this has been ridiculous, okay? Although all of these weeks did see intraday or intra-week drops below. So I'm not, squaring off this euro just yet. You might have picked up yesterday, by the way, if you were on the Daily Effects webinar. There's a lot of people, and again, I don't want to speak poorly about anyone's analysis. Everyone trades differently, but there's a lot of people sometimes that when they come out with a conviction call on these majors, tends to be sort of a retail signal to fade. And just a lot of people were getting bullish yesterday. And as I said in the webinar, it just seemed too easy for this thing just to hold support here and bounce. So as we were looking for a last kind of flush out before the resumptive move higher. Now, I don't want that flush out getting much lower than like 1130 max, and the weekly close would still need to close the week above 1186. So the bullish call on euro is getting harder and harder as this thing pushes sub 1180 here. Don't try to be a hero on this. Obviously we were looking for some sort of exhaustion low in this region, but we haven't seen that in near-term price just yet. So the focus is going to be on how we close today. Again, 1130 is going to be the low close for the year. 1107, the actual swing low for the year. At the end of the day, if we settle here, guys, and we get 1180 as sort of either a resistance bounce or it holds on the close, you're talking about the possibility for a big slide here. Now, when you try to factor in, what's going on the fundamental side, is this warranted? It's tough for me to get comfortable on trying to press any shorts from here. Watch this level, okay? It is absolutely paramount. And again, forget everything I'm saying. Forget Mike Boutros. Forget Jamie Setley. Look at what price action has done at this region. Huge pivots in price, pivots in price, pivots in price. It was the actual swing low for that June drop here in late June. And again, Fibonacci level, the low day close. It's loaded. It's loaded with technical factors. So, if this gives out on a closed basis, it's also a break of what? Just like we talked about in the DXY, it's an objective break of the monthly opening range. Here's your monthly open. Even if you count this as the opening range low, we set it back on the 9th. We tried to rally towards the high, couldn't even get it. Held that low, tried to rally towards the high, couldn't get it. If this is a legit break, we close below 1180, that would be, again, an objective monthly opening range break, shifting the risk lower into the close of July trade. So, man, we're coming up on some critical levels. And I feel like I've said that a lot in Euro, but we've been sitting at this level for months, okay? So we're not going to just kind of discount that. This is critical. If we close at these levels, certainly the risk for the euro would remain weighted to the downside. From a trading standpoint, any shorts that you're holding, you kind of want to keep a cap over 1187. Specifically, the weekly open would be where I would draw the line. Even if it rallies towards that and it holds and moves lower, that's still bearish. But that's sort of where I'd start to look for a little bit more of a constructive play if we're able to get back above. Okay, so stops down, if you're on short side of this, stops down 1213 or higher. If we continue to see next press lower, there's really nothing until you get towards that low close for the year, and that's 1129. Big levels here for euro. Big levels, and an attempted push below the monthly opening range lows. Pay attention. Questions on euro dollar? Okay. One other thing, just to throw it in the mix there, don't forget the ECB interest rate decision. Obviously, we're not expecting any major changes in rates there, but the commentary is always going to be the play there, and that's still on tap this Thursday. So some event risk left for the euro, US GDP numbers on Friday, some event risk left for the US as well. So that is euro. Ty, let me know if you have any questions there on euro. You were looking for the euro update. That's number 3. Back to last night's update, dollar CAD number 4. If you're holding longs there, we were talking about it yesterday. This is your first major area of resistance. I wouldn't be looking anything beyond this. So 31.45 is kind of where already I dumped it. But here it is on a test of slope. Very similar to the euro. It's testing the monthly opening range highs. Here's what it looked like last night. We noted there was a breakout in price, and that breakout was essentially holding near-term resistance. The February low day close is 31.23. Next upside target 31.45, and then there's that confluence region. This newly added pitchfork just off the lows had a nice play along the median line. That break had us looking for this region right here, confluence of the 75% line, and basic channel resistance. Here's what it looks like on the daily chart. Nothing fancy here. Just off the yearly high that we set, or I guess this is not the yearly high, but the May high, May and June high. 2-point touch, this would be the third. We need to see what happens, but objectively, it is the opening range high for the month. Watch today's close. Are you guys getting this thematic play on all the majors? Really all pressing critical areas on both weekly and monthly range levels, and as well as the longer term trends that we've been following for the last couple of months. So gotta pay attention here. It's hard to imagine a scenario where the dollar just continues to rip, but if the material closes on the euro, Kiwi, DX, or dollar CAD all press the close at these levels, we have to allot the fact that we could be looking at a near-term breakout here. So any further from here on dollar CAD, the next upside targets, you're going to look for that slope. That's going to be variable based on time. It's somewhere just above 32 at this point. Basic 38.2 of the drop from the highs that we placed in May. Objective range gives you 32.27 on the upside. So that's the potential if this breaks here. Immediate focus for me, and again, this is just my humble opinion, I'm looking to see if the US market opens and this thing exhausts here and starts to pull back. Even in that case, it would be a short counter trend trade just at near term. We'd need to get through 30.68 to validate, or to invalidate, let's say, the break of this of monthly opening range. But that setback, look for the median line, look for the former swing highs from Friday. Those would be the levels of which you want to see hold just above 31. If the exhaustion pullback here is just going to be a short-term pullback, then rip higher. So again, hard to get excited about these if you're not already in it. Use prudence here. And again, just a quick look at the dollar CAD weekly chart. Why we were looking for dollar CAD support to begin with. This is something we've been talking about since last week. This 29.70 area, 30.52 area on the weekly chart. Huge. basic 38.2 retracement of the yearly range, 100% extension from the decline off of that December high, slope support, all converge there. That being said, what we've been talking about for the last couple of weeks is the fact that this is basically a probe below the yearly opening range, right? There's your low that you set back in January. If this was a legit break of the yearly opening range, you'd want to see acceleration, okay? Here's the break of the 2017 opening range to the downside. 2018 didn't really give you yearly opening range. It just kept on climbing higher the entire year. Here's this year's open. You set a low. You fail ahead of the highs. If this was legit, we'd want to see acceleration. The fact that we're seeing price pause and this rebound is what basically is focused on, or puts the focus rather on this major near-term resistance range. See what happens here. Questions on dollar CAD? Going once, going twice. Sold. Number 5, Swissy. Here's another one I wanted to highlight last night. You guys know how I feel about Swissy. I'm not typically a big fan of this pair, but I think the levels were pretty clear. Here's what the chart looked like. The weekly chart didn't really have much by way of something really prompting an operation to get on this. But the only thing I wanted to highlight here is that we're essentially holding this key zone, 98.28, 98.38. It's the 2019 objective yearly open and a basic 786 of the yearly range, right? We've basically probed a new low there, so I don't want to put too much emphasis on the 786. In fact, I'll just scratch that right now. But where we're trading, big, right? For all the talk about opening ranges that we've been going over the last couple of setups, this thing has simply made a full round trip. Here's your yearly open, spike into a low, you set a high, you defended that low last month, and you're just holding the yearly open. So essentially, Swissy is unchanged on the year. Okay, pretty significant stuff. Nothing here on the weekly chart to really prompt a strong opinion. Here's the daily. Oops. Okay, and here's what it looked like yesterday. Right? Near-term resistance looks like, if this is to be interpreted as some sort of 5-wave extension, the 100% had me looking for a little bit of a drop lower on the intraday. I was looking for a possible exhaustion at 97.90, 97.73. We still might get that. Okay, we still might get that. There's nothing here to actually dissuade that opinion. But at the end of the day, there's two formations that could be at play. If this parallel series in red is in play, that lower parallel converges on the 100% extension. Okay, if the falling wedge is sort of the play with this trend line, which already has a 3-point, 4-point, 5-point touch, it puts the focus on a breach above 98.73 to mark resumption. Okay, so from my standpoint, this one's kind of still, I hate to say it again, yet a wait and see. For me, I'm looking for exhaustion on a stab towards 97.73, maybe 97.90. I'd prefer down here. Or if we rip, it needs to be a breach, come back and retest for entry near 98.73 for the rebound higher. Couple things to note, okay? We just posted an outside reversal candle off the highs. Is it also a 4-hour? It is also a 4-hour outside reversal candle off the highs, taking us back essentially into the weekly open, okay? So for all intents and purposes, you've just set, really tight in your term range since the start of the week. Still think you could get that drive lower before this thing rallies. It's hard to get comfortable with that because the dollar just keeps ripping. But keep in mind, despite the fact that we've seen the dollar show some strength here, Swissy's kind of been doing its own thing a little bit. So we want to make sure we're taking every trade on its own merits. Note that momentum failed right ahead of 60 here on the upside. We haven't seen a 60 break in momentum since that high that we registered earlier in the month. Really still keeps the risk is for that spill lower first to get long. Ultimately, 98.73 pop is what I'll look for to start to look for the sort of a larger advance towards 99.65 and above. So Swissy still favoring a long play if we get a drop lower or if we get the crack above 98.73. From here, There's not really much pushing into a long position. Questions, comments, concerns. Don't forget, by the way, 97.73 is what I'm looking for with great interest, but just lower. And I think this is what Jamie's putting has as his watch list for the Swissy as well. Just lower, you have that uncovered gap from June. Okay, the June close came in right here. We opened, or towards the end of June, we opened that following week back above towards 97.88. So there is an uncovered gap at 97.60. I'm not a stickler for that, guys, to be really anal, has to fill the gap. The markets don't need to fill these gaps. But if you see that downside break, it still gives you a nice little butter zone here of like 17 pips, 13 pips to look for, possible exhaustion for the downside. Questions on Swissy. Here's the 120 minute just to show you the near term. Okay, that is number 5. We're making good time today. Peter's in the room. Pete's in the room. Oh, we got all 3 Pete's in the room today. So SPX, number 6. It's just the levels have been really clean on the intraday, which is not something I tend to get too focused on. But look, here's the SPX. If you go to the previous update from the 17th, you'll note that we were highlighting a near-term support. The first level of interest was the May high here near 29.59, but obviously that slope support was also there, okay? So at this point, we've simply dropped into slope support and rebounded. Here's what it looked like last night. Dropped into that slope support. Again, the median line converged there as well. Here's the rebound. The way it reacted, where it reacted, how it reacted with divergence into the lows, basically had the risk still for a pop higher. Now, the 3,000 mark, aside from it being a psychological figure and all that good stuff, turns out to be the exact 618 of the entire drop. You want to sprinkle some more, sprinkles on that? You also have the upper parallel converging at that level, and all of that looks pretty clean as we head into the U.S. trade session. Here's what it looks like. 3,000, again, a psychological barrier, a level of which, just a big figure level of resistance that you look for, just higher on the intraday spike. If you get it, you got that parallel. I'm looking for exhaustion here. Okay, now, not to get overly bearish on risk, obviously markets do like lower rates, and we're expecting that, heading into next week. Went over with you yesterday, guys, the Fed Fund futures still pricing in about a 25% chance, above 99% that we're going to get the cut. 25 is still calling for a 50 basis point cut. So if we get a larger cut than expected, that should fuel some strength in stocks. That would be positive. That being said, objective resistance coming in just higher near that 3,000 mark. Watch it today. Watch it today. Listen, this might be all she wrote, right? Again, the longer term view here, here's the 240, right? All of these slopes have just been super clean. Here's the lower parallel, right? Here's the median line. If there's more downside, this should cap the advance. Top side pop from here, guys, and you're already above the high day close. You're looking for 30.19, period. Actually, I'm sorry, the high day close is 30.12. Let me just add that on there real quick. Okay, soft target there if you get to the top side. But for me, it's all about this region right here. If you're going to get failure, guys, this is where it would happen. Shorts that you take, if you do get a failure signal on near-term price action, would need to be against that Friday high, okay? And obviously the downside targets would be pretty much unchanged. You'd look for a break of that slope. At this point, it's here right around 2980s, 2983. For the validated break of a larger decline here towards 2955, 2960. It's your big zone. Any questions on the SPX or risk at this point? All right, next on tap, Let's hit Aussie, number 7. Here's Aussie on the weekly charts. Not surprised to see some pullback, but that pullback's got to resolve pretty soon if this thing has any hope of clearing major, with a capital M and a capital Ager, resistance here at 70.42. What is it? It's the objective yearly open. It's a 3-point resistance trend line, also converging on that region. Momentum just below 50. From a weekly standpoint, couldn't get more definitive than this, especially because last week we topped it, but we closed right there. Here's what it looks like on a line chart. Okay, so we're right in the sweet spot. We're right in a huge pivot, major swing lows for the opening range for the year. The crack saw a massive decline. We already tested this region as resistance. Here's where it all meets up with basic trend line, yearly open, former swing lows. Critical resistance here for Aussie. So what was the game plan? The game plan was to look for a pullback. Ultimately, that pullback should find support nearby. 70.05, 70.06 turns out to be a really nice spot on the near-term picture. That's based on a basic 100%, 2 equal legs off the high, gives you 7.006. The low day close for the year, that massive, huge washout we had in January, gives you the 70.005, and obviously we've seen some major pivots there. So for the Aussie, still looking for a little bit deeper of a drop. Again, it's a very similar scenario to some of the other crosses that we're looking for. I want to see a hold at 70.06. If we get any weakness beyond that confluence support zone right here, just below 70, you have those lows from last week. I think at that point you relinquish the long side and you kind of let this thing, you got to shelf the idea for the long side there on Aussie if that materializes. Immediate focus is still drop lower, but those are the two levels I'm looking for, just below 70 and right at that 70.05 or 70.06 region, to see if we can't get some recovery. Questions on Aussie? Do get some PMI numbers later tonight from Australia. Not expected to be a major market mover. The bigger play, or the bigger risk, event risk, headline risk for Aussie is going to be comments by the RBA's low, and that comes on Wednesday night, Thursday morning in Australia. All right. Any questions on Aussie before we move off? Again, here's what it looked like earlier in the week as we were opening the week just above that slope support. Gave you a nice bounce. Man, here's the break, test of resistance, both areas of interest if we get a drop to see for exhaustion. And on this trade specifically, guys, just as, again, a side note, the weekly opening range high would be, for me, the validation for the resumptive trade. You'd be looking for 70.75 as a soft target. I think you make it through on the second turn. You look for the April open. Obviously, it's all contingent on a swing back above yearly open resistance, but at this point, look for support a little bit lower from here. Questions, comments, concerns? So I recognize that, yeah. So the swing trade stop, guys, is 7.005 from last night. Jamie put that out. If you get that stab, I would just be looking for reaction in price there. I don't want to alter our expectations, guys. We're working with two different strategies. So from a swing side of things, you kind of need to let those stand alone. We don't want to start moving around limits or stops just to account for something like that, because it will tend to weigh on your risk to reward ratio over time. So hopefully we see some sort of fade action from just a little lower. That is Aussie, number 7. Any other majors or FX crosses? Let me know if you have any questions, guys. The rest of the updates that I have are gold, crude, Bitcoin, and I have a note here on Euro Kiwi. I don't know if any of you are involved in that setup from last week still. But let's just hit Euro Kiwi real quick, and then we'll come back to the com block. Here's Euro Kiwi. So here's what the setup looked like back on the 18th. Really tight channel. You guys know how I feel about these real tight channels. But we were looking for exhaustion. The play was the low day close, the 100% extension. That's exactly where this thing turned from. 65, 48, 65, 46. You got the low day close for the year. You got the 100% extension from the decline off the June high. So boom, boom, boom. Gave you a confluence zone of 65, 46, 65, 48. And that's where you saw, obviously, ongoing divergence. There is, on a 120-minute chart, it's not the cleanest, but I was looking at this yesterday. There is a trigger that gave way, and then here's the break back above the weekly open, charging that move. Look, we can't validate this as a reversal yet, but I do think that Euro Kiwi has some more upside to go. Matches with a little bit further of a pullback in Kiwi, even if it's not necessarily Euro strength. But here's the chart. Guys, we came down the back of what? 1, 2, 3, 4, 5, 6, 7, 8-day decline. Covered the entire massive, or I guess it wasn't massive, but it covered the entire monthly opening range. We broke back here on the 15th, looking for a late month low. There's that low day close for the year. There's that 100% extension. What a beautiful spot to find some support. Again, not the time to get superly bullish. But if you're holding shorts, expect some upside from here. If you're looking for new opportunities, I wouldn't necessarily say get long. That trade was last night. At this point, you should be looking for exhaustion. 6680s, that's 618, former slope support, now resistance. If we're going to see some recovery, I'd look for failure here before resumption. Okay, so Euro Kiwi, what an interesting trade. It tends to fall into these times where it doesn't do anything. And I remember this when we were sitting right here at support for weeks. This thing was just going sideways, not doing a damn thing. Here's the rally. We turned really aggressive here. Really nice area of resistance. You got a nice pin bar, failure. Next week, we came crashing through yearly open, and then we tested that as resistance 2 weeks later. We've been looking lower. The downside target 6680 and right here. This is weekly confluence support, guys. This is the uptrend that we've been following since 2015, 2017. 25% line has been decent. Support, support. And again, even this drop here on a closed basis is as close as it gets. Okay. And then again, obviously on the rally, nice spot for failure. Here's again where you want to pay attention for some possible near-term support, momentum testing 40 on the weekly chart. So there's a lot to look at here. I do like a little bit more of a support bounce. Obviously, don't ignore the fact that we posted here, very similar to what we were looking at on some of the other majors, an outside reversal candle. Whoops. Also on a 4-hour time frame. So pullback, near-term support, 65.75. But I do want to see if we can't get a stretch, excuse me, or possible back exhaustion on a move towards 66.80. Questions, comments, concerns on Euro Kiwi. That is number 8. All right, gold. Lots of questions on gold. Hold. Pooja saying a hold of 65.75 for a long in Euro Kiwi. Explain that to me. What do you mean, Pooja? So if you get a breach and a retest of that, that's where I'd be looking for the entry. Because it's a pretty major pivot. Note again the swing lows that you made late in April. And even like those March highs, the March open comes in right around that level, 67. But if we were to break through this and find support there, yeah, that would be sort of your launching point for the next thrust higher. But for me, that's the pivot essentially, is 66.80, 66.75, this region right here. Pooja, does that make sense? I just want to make sure we're on the same page. Yes, all right, she says. Gotcha. I mean, this is the spot. This is the spot. Now, the ideal scenario, by the way, to try to play the reversal, or if you're going to play the thrust higher, is for us to get some sort of high-low high, or low-high-low in this scenario, to get some sort of formation for a slope upside. Till that happens, you're basically looking at former pitchfork support. If that were to breach as resistance, yeah, that would put you on a little bit more of a constructive path. Okay, gold. Yeah, this is big here. I think there's a whole lot of fake out happening in gold right now. My initial inclination, as I was telling you guys yesterday, was to look for the pullback towards 1409. Specifically, 14 would be sort of the max thrust you'd want to see the downside if this is going to play. We've come into huge long-term targets, guys. And every time I talk to someone, either a client on the phone or various colleagues in New York, it's not a call for a reversal in gold, guys. It's a call for we're testing uptrend resistance. So yeah, I'm still bullish gold long term. Am I immediately bullish from right here? To be honest with you, yes. But does that prompt a trade for a new long position from here? Absolutely not. Look at the reaction we got at 1451. That was a huge level. Guys, those were our quarterly targets. Okay, it made quick do through them, right? Only a couple weeks, took out the 1391, 1433, and 1451. But we haven't closed above 1433. That's a swing high from the late 2013 advance. Again, the fact that intra-week spiked into that and we closed below still has me thinking you get a better entry for a long-term position if you're looking for a longer swing type of setup for gold. That said, weekly momentum's in overbought condition. That doesn't happen very often in gold. As long as that's in play, the risk for the broader term still remains to the upside. I brought this up to you the last couple of webinars, guys. The last time we saw gold in overbought condition on a weekly basis was right ahead of the all-time record highs. So it suggests it's not the best time to try to fight this just yet. In fact, the downside trigger below 70 on that reversal into the record high was sort of the onset. That high never got tested again. So the trigger on a momentum close basis below 70 is definitely beneficial to try to press a short at that point. From here, you're coming off a big region of resistance. Okay, here's the daily chart. Here's the last time we looked at gold on SB. Right here, right? Talked about the fact that the July open would be your first level. It's 1409. And again, former channel resistance, turn support, support comes in at 14. So from a daily standpoint, if you discount this as some sort of false break, the pullback, that's still where you'd want to find support. 1381 would be an objective monthly opening range break, and that would just be bearish, period. So looking for exhaustion, 1409, 14 on this stretch. If the price is heading higher, if this is a near-term rising wedge formation, well, then the downside break here should see acceleration. And at that point, you'd be looking for the range lows. So again, I'm still of the mindset you need to let this thing set back before you get back on the long side. As far as trying to play the short, I see your question there. As far as trying to play the short, listen, if you're comfortable trading counter trend, just make sure you're using responsible stops on it. But even from that, your first target would be 1409. And yeah, your second target would be 14. I really wouldn't target anything beyond that. If it gets the break, it's a different ball game. But this has been a wildly constructive trade in my opinion. We're coming up against huge levels of resistance, so it's worth giving this thing a little bit more of a room for the kickback, I think, before trying to get too aggressive on it. Any questions on gold? Next one up is crude. Here's what the crude charts look like. So again, as we noted yesterday, it just turned ahead of that 54.52, 54.60 target. Here's the upside thrust, failure ahead of the 38.2. This thing just seems like it doesn't want to hit any targets, wants to just contract within the range. Again, one of those trades where if the opening range break that we saw last week was legit, you basically want to see these resistance levels start to hold. I had 57.08 on there yesterday because it was a basic 38.2, but if we break that, yeah, you're looking for a rally back towards the yearly open, monthly open, 6.8 gives you 58.15, 58.53. Again, I'm of the mindset that you still get the 54.52 tag before all is said and done on this. So on this one, by the way, the weekly opening range is really clean here. So your weekly open actually ends up being the weekly opening range lows. That's 55.72. Look for the break there. That'll give you a resumption. 54.52, 54.60, still the zone of interest for me. My favorite confluence regions, I tell you guys that all the time. 100% extension off the high, 618 off the low. Nice inflection, former swing highs, the break below saw acceleration back in May. Just a really nice spot. Questions on crude? That is number 10. We made good time today. Any other setups you guys want to review, do let me know. Feel free to throw them on the message board at any point. Just a quick note on Sterling, because obviously Boris Johnson and the news of the new PM having me look at this with great interest. Look, I'll show you this chart in a moment. The one thing I want you to focus on is this, weekly. Okay, 123.74. We talked about this yesterday again, 124.33. It's a bigger zone, okay? 50, 60 pips of support. It's the low day close from 2017 and is the post-Brexit low day close back from 2016. Huge region. Again, don't forget that the yearly opening range lows comes in right here. So much strain on this. So you start to think to yourself, well, does a Boris Johnson-led parliament bode poorly for sterling? I don't necessarily think it's kind of clean cut and dry like that. The whole focus is going to be on whether you get a Brexit deal or whether you get a no deal Brexit. And I think that disorderly sort of decoupling is really what the markets are focused on. So my whole point is, this is a huge zone of support. We started to look for support here a couple of weeks ago. It's been 3 weeks. Initial testing has been obviously encouraging, but weakness below 23.74. Man, look out below. Okay, so that's my line in the sand. If we're going to get exhaustion, this is sort of the zone to look for. Here's the daily chart. You could see again. You could see again. This playing out in 2 ways. Here's your basic slope off the highs. A parallel of that from that swing low in February saw support, 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 support last week. Okay, again, there's that first post-Brexit low week close, 24.33. We're testing that now. If this were to break to the upside, we'd be on course for a decent play. Till that happens, I'm just looking for further divergent points, further exhaustion on downside moves. And the fact that every time you turn on CNBC or Bloomberg, everyone's saying, oh, well, you probably see sterling drop another 10% because of, based on what, right? Obviously, again, weakness beyond the lows that we've made. There's nothing until like 22s and change. But until we do, you've marked some divergence into this last low, lower low in price, higher low in the oscillator. That is the third reference point of new lows and equal or higher lows in the oscillator. And this is huge lateral support, the yearly opening range lows, last year's lows, huge region. Watch today's close. Okay, so quick note there on sterling. Last but not least, Bitcoin. I only bring this up, guys, when the charts warrant it, and this thing has been insane clean, like insane clean. The level we talked about last week, 90.57 to 89.35, that was sort of the major critical support zone we were looking for. You had the lower median line parallel there. You had a 50% retracement. You had 100% extension. We found support right at the upper bounds of that near-term zone. Okay, so here's the thrust higher. Failure where? At that key pivot that we talked about yesterday, 1099, 11, 171. Huge, or 10,990, excuse me, 11, 171. Huge region, again, major confluence, basic pivot in price, objectively speaking, from the lateral level. Here's the pullback lower. Levels of interest on the downside right now, you're heading into at 98.40. That's just a 618 of the near-term rally. If we get back below this slope, okay, you're basically looking for another drop into that key zone. 94 or 92, yeah, as a soft target, maybe peel a little off there if you're, aggressively positioned. But basically, for me, if we break this pivot, by the way, on a 4-hour basis, and I think on the 2-hour basis, yes, the close lows, okay, from back here in the year opening for the month, right? Those were your lowest candle closes for that drop. It's the 618. Obviously, the pivot drop that we saw there last week on the breakout, 618. Look for a reaction here. Look for a reaction here. Ideal scenario, you see some sort of bounce, opportunity to get back towards that median line, but the risk remains lower, sub 1099. And again, I think yesterday in the webinar, we even pointed out that 4-hour reversal candle, something to pay attention to off the highs. So Bitcoin coming up on support. The pain might still have more to go if we get below 98.40. That being said, this is your first major downside target from that 1099 turn. Okay, and that is number 11 and 12. That's all I got, guys. If you have any other questions or trade setups, feel free to throw them on the message board. Again, our next session, obviously Jamie will be up with the midweek strategy webinar tomorrow, but we'll be on Thursday. As we're doing the Thursday webinar, guys, we'll be it'll be just minutes ahead of, or I guess about an hour ahead of the ECB rate decision. So we'll go over the Euro crosses, what that means for the Euro crosses and the positioning as Euro is basically testing a critical region here today. Don't get suckered in. Whoops, wrong charts. Don't get suckered in, guys. Use some prudence here because these are some major critical levels. Every time we've approached this slope on all of these, it looked like a legit break. But as we discussed earlier, it wasn't always the case. Now, truth be told, this is one of the deepest stretches that we're getting below since that May decline. And if we close below today, 1186, I think it bodes really poorly. I think there's a lot of room for the downside there. Okay, we will pick things up back on Thursday. If no other questions, we'll go ahead and wrap it up here. Thanks again, and best of luck trading. See you Thursday. Cheers.